The information contained in this podcast is an expression of opinion and does not constitute investment advice. This is the Gold Money Podcast with Alasdair MacLeod, keeping you up to date with expert opinion on precious metals and the markets.
Hello, this is Alasdair MacLeod on behalf of Gold Money, and with me on the line is Jim Willie of the Golden Jackass, and who also writes the hat trick letter. Sorry, I got my teeth all tied up. Jim, welcome very much. It's great to hear you again. I think we last spoke in about November, wasn't it?
Yes, it was, and I don't mind being a half track because that's kind of like a locomotive train.
Well, at least it goes somewhere. I was very, very interested, Jim, to see that you wrote quite a detailed analysis of currencies on your Golden Jackass site, which you entitled "Currency War and the US dollar Rejection." Now, how do you think this rejection of the US dollar is that actually happening now? Do you see it? I mean, what is the state, if you like, of the US dollar as you see it? As the international trading and settlement medium?
Well, I think for the last several months, there's been more non-dollar trade settlement, and that's really the key. In the past, driven by crude oil, led by crude oil and OPEC, all energy transactions have been done in dollars, and as a result, all trade settlement has been done in dollars. It seems that since the Iran sanctions of last March, and we're talking now 10 or 11 months, there's been a tremendous movement to settle trade in different innovative ways. It starts out as innovation in order to prevent a complete strangle of Iran. And, I don't want to get into the politics of nuclear development and, weaponry, or whether it's energy production or what. It's beside the point. Right now, the issue is that innovative methods have been on track and in development. And I think they're really accelerating toward non-dollar settlement. And, we've got a whole lot of non-dollar settlement for years. Started in about 2005 when Brazil and China instituted their bilateral Yuan currency swap. Well, these swaps, Alasdair, have been largely ignored, but there are a whole lot of nations now. It's not just Brazil, but it's Australia, an Anglo nation, South Korea, Russia, and Japan. When Japan signed up for the bilateral swap accord facility with China, I thought that was enormous news. I think that was back in the summer, maybe around June or July. So that's non-dollar trade. That's ignoring the dollar for trade settlement. When Brazil and China conduct trade, they're openly stating, why should we settle in dollars? It's a third party. They're not involved. Well, so they set up these bilateral swap facilities for Yuan. It's like a credit card, and one side makes a deal and the account goes plus or negative. Another side makes a transaction, it goes closer to zero. It converges towards zero. Whereas with the United States, everything balloons out of control, gigantic in size.
Yeah. So if I can sort of just come back, because I want to spend a little more time on these yuan swaps with you in a moment, because I think that's a very interesting topic which you've identified. But if I can just come back a little bit to Iran to remind our listeners, I think it must have been nearly a year ago that the US turned round and banned anyone from doing dollar settlements with Iran. And then I think I'm right in saying that the Brussels-based SWIFT, the banking settlement system, then banned all settlements in any currencies with Iran. And Iran, who are major oil exporters, particularly to India and China, and to a lesser extent Turkey, then started dealing with a settlement in gold. But the settlement in gold was on a net basis. I think if I understand what you're saying about the yuan swap system, it is effectively settlement in yuan on a net basis. Have I got it right? And do you think this was stimulated very much by Iran's experience?
Well, I think that you've got the concept correct. As I see it regarding the yuan swap facility, I mean, two nations conducting trade will go back and forth, and it will converge on zero, or they'll aim it to converge on zero. But the key is that it's non-dollar. The Iran issue, they're trade partners with India, trade partners with China, but with all of their neighbors, really, they neighbor with Turkey. I'd like to point out Turkey is doing something, and I got this confirmed with my best gold trading source. I call him the Voice. I like to protect his identity. He's a very bright fellow. I haven't found him to be off the mark on anything in the 4.5 years, almost 5 years that I've known him. He called me anonymously on Skype one April 2008 morning and really knocked me off balance. But he's a great guy. I asked him about 2 months ago, Turkey is doing some things. Turkey is acting as an intermediary in gold purchases to facilitate transactions. Could it be that Turkey, I asked him, could it be that Turkey is trying out an experiment to settle trade in gold, acting as an intermediary, as a third party? And he said, you're on the right track. You see it correctly. And he said a few other things, but that's pretty much what Turkey is doing. I call it the bazaar. The Turkish bazaar is available and open for purchasing gold in the open market in order to settle in trade. It helps out their neighbor, Iran, but there's more to it. India just got permission for its banks to purchase gold. Now, is that so that Turkey and India will act as intermediaries in gold settlement for the Eastern nations? Something very big is going on, Alasdair. The key is that it's non-dollar trade settlement, and the climax would be that it's gold-based settlement. And that's the direction I think we're going.
Well, that's very, very interesting because I think that we've all been looking at how gold becomes remonetized. Does it become remonetized? We look at the relationship between paper currencies and gold, and we know that the flexibility that would be given away by central banks if they went on to some sort of gold standard would be completely unacceptable to the central banks and the politicians. Therefore, the only way gold comes back is we have the crisis first, the destruction of the paper currencies, and then gold comes back as money. I think that broadly is the script that people have in mind. Now, you're suggesting something rather different, which I think, on reflection, has quite a bit of merit. If a country like Turkey decides to settle its trade with its major trading partners on balance with gold, then the parties to those transactions are going to be quite keen to ensure that the transfer at the end of the day involves as little gold as possible. So this would bring in an automatic discipline on international trade. Have I got this right? Is this where your thinking is going, Jim?
Yes, and very much so. And if it's on a net basis for the movement of gold to satisfy the transactions going left and right, as I like to say, the desire, the motive will be to have participants that are not deadbeats, participant nations that actually produce something and export, nations that don't build imbalances in deficits, whether they're current account deficits or trade deficits. It doesn't really matter. They don't. The system is not going to want deadbeats that just build up debt and imbalance. They're going to want to have viable players. And that's why I think the United States is in real big trouble and great risk for this new direction in trade settlement, because take a close look at the United States. They export debt paper securities, whether they're Treasury bonds or mortgage securities, and they import finished products. They dispatched in 1999 through 2004 much of their industry and factories to Asia, in particular China. That, in my opinion, was a hara-kiri suicide initiative. No nation in its right mind that wants viability and sustainability and healthy economy will discharge its industry. Germany didn't do it.
Well, no, you're right. But I mean, this is the consequence of monetary policy ever since World War II. I mean, they've been destroying savings. I mean, we noticed this in the UK in particular. Successive governments have tried to destroy wealth, individual wealth, and the effect of that basically is that the financing of production has driven that production abroad, because that is where the wealth is now. It's no longer in this country. And presumably America's got the same sort of thing. We've been driving our business abroad through regulation, through discouragement of savings, through getting business cycles going the whole time. I mean, I don't think there's anything new in that. But the sort of the trade thing then becomes very, very important, because as you point out, this means that countries like the United States end up with continual trade deficits, which are as much a reflection, if you like, of the destruction of savings as anything else. The result is that all their creditors end up with their paper. And this is a very unsatisfactory thing at a time when central banks, particularly the Federal Reserve Board, are now printing at an accelerated rate. And I mean, presumably this is really what is driving the Asian countries, particularly China and Japan and so on and so forth, to try and move away from the dollar. And has this been the motivation for these yuan swaps which you identified?
Well, I'm sorry, let me comment. You made a number of points about labor and industry and balances. I'd like to comment on that, if you don't mind. Why in the 1980s was the United States so urgently motivated to move their industry offshore? It's because the labor costs went up. Now, you could make arguments all day long about, well, there's so many Chinese laborers out there that their sheer numbers would make it cheaper for industry to exploit their labor at a lower labor cost. Well, that makes some sense, but there's something much, much bigger involved in the 1970s and 1980s and late 1960s, and it's called war. I don't find that there are any economists out there, I mean any economists out there, who make the point that war and the fascination with war and the adoption of war and devotion to war by the United States increased its labor costs. I remember in the late 70s, price inflation was raging at 10, 12, 14%. The first 2 years after I exited graduate school, my first 2 years of work in 1980 and 81 and 82, the raises were 12%. Everybody got a 12% raise. The labor wage inflation responded to the Vietnam War. War has an effect, and what it has done is caused the deindustrialization of the United States and an erosion of capital. And the erosion of capital has gone haywire and gone wild, Alasdair, because since QEs, the quantitative easing bond purchases, the erosion of capital and destruction of capital has been monumental, not just the United States, but in Western economies. So the effect of war has been to ruin capital and to shift the capital devices away from the United States and deindustrialize it. That's why we're shipping capital out of the United States. And lately it's been in the form of debt. And I'd like to mention something that happened just today regarding a news report. And I have to get some of the details out, Alasdair. I mean, this is not, everything's not painted black and white and very clear. But the U.S. enjoyed something like a 20% decline in its trade gap in December. But it looks like there's a huge amount of exports of industrial supplies. And I'm being told that we have, in just 1 month, we have an increase of $1.2 billion from November to December in exported gold. that they're calling non-currency industrial supplies. I'd like to say that's a bunch of bull, or as you guys like to say, bullocks, because what are you talking about? O-rings for cars, for catalytic converters? No. We're talking about gold bars being improperly classified as industrial supplies. That I think we're starting to see now foreign nations demanding U.S. gold in order to satisfy trade.
I've got, I think, two sort of contrasting emotions to that one. I mean, apart from deep interest in this, if it is true, the one is that it's amazing that despite of everything we've heard, there is some gold in America to export to pay. And the other thing, actually, is that from all one's led to believe, the US would be very reluctant to pay for anything in gold.
Well, then one must conclude that if this story is correct, and we do see, let me just cite some of the figures. For October, there was a negative $2 billion in exports of industrial supplies. In other words, industrial supplies came into the United States. But in November, it was plus 1.0 billion export. But it went up to 2.6 billion in December. That's an increase of $1.5 billion in industrial supplies. And I'm being told it includes 1.2 billion in non-monetary gold. I'd like to know what form is that gold and where did it go? My guess is it's not to England, where some trade deficits could be settled in Treasury bonds with utter ease and acceptance of debt securities. My guess is that it's in the non-friendly nations that are sick and tired of toxic U.S. Treasury bonds being used to satisfy trade when the central bank in the United States, the Fed, is monetizing everything under the sun, doling out trillion-dollar gifts and loans to their buddies, and undermining and debasing the U.S. currency. That is the motive for all these central banks taking action. They're sick and tired of the QE programs, the hyper monetary inflation, which should be called Weimar 1, Weimar 2, Weimar 3, and they're up to Weimar 68 or whatever. Calling it quantitative easing, I mean, that's like, calling rape, a fondling.
Yes. Going back to the term non-monetary gold, I think I can throw a little bit of light on that because it's a subject I've been looking at in the light of the United Kingdom's trade statistics. And what we mean by non-monetary gold, I believe, and I've still got to do more research on this, is gold that is not, if you like, held as part of a monetary reserve. Now, this means that non-monetary gold can easily be gold bars, of deliverable standard. And I think essentially it is a question of the ownership. Instead of it being owned by a central bank, which would be monetary gold, it might be owned by a government or a government department, if you like, or alternatively by some extremely wealthy people. I could envisage, for example, gold being moved from the Middle East to somewhere like London. If there were concerns in a place like Qatar, I just take a name out of the air, that being so close to Iran is not a good idea to have your wealth stored in the Middle East. So I can see that essentially is what we're talking about when we talk about non-monetary gold. It's not exclusively deliverable gold. It can be other gold as well, but the bulk of it would be gold which we would otherwise regard as monetary gold, but it just doesn't happen to be owned by a central bank or maybe the Treasury Department of a government.
Well, the non-monetary holders could be refineries. And notice in the last year, there's been a tremendous amount of export from the United States of gold dust, flakes and little chips and small pieces of gold, not in bar form, not in coin form, and not in the impure version of dory bars. There's been a lot of gold dust and flakes being exported, and my guess is that a tremendous amount is headed straight to refineries where it's going to be converted into bars. So
right.
I agree with your argument, but I'd like to just raise the refineries as one possible non-central bank holder of this gold.
Yes, of course. Yeah. No, I think that makes a lot of sense. Can we sort of talk a little bit more about these yuan swaps? Now, I think I'm right in saying that on your article, which I referred to earlier, you do refer to a number of nations. I mean, people like Russia, China, and so on. Brazil, obviously. How much of China's trade do you think is being covered by these swaps now?
That's a really good question. I would venture a guess that it might be over half. I'm not really sure. As I said, I'm guessing. But the biggest participant that's not involved, the big trade partner that's not involved in the swap accords, is the United States and Canada. England, for instance, I don't think they have one. But note, there's something very big in the news in just the last couple of weeks. The Bank of England has announced that they too have instituted a new Chinese yuan swap facility out of London, and the storyline really made it sound more like, well, London wants to be involved as China gets more and more in the business of selling bonds and initiating, say, stock offerings or corporate bond offerings. London is a giant financial center, to be sure. They don't want to be left out as China comes of age in the era of paper, paper securities, issuance of bonds, issuance of stocks. And I think what the story might have been deceptive was in describing how China might be demanding that London pay for its imports with this swap facility or use the swap facility. China might be saying, we don't want any of your gilts anymore. This is complex, and we're going to learn more about all this. But I don't believe that England exports too much to China outside of debt.
Yeah. No, I think that's an interesting point, because I saw the announcement that London was trying to get a toehold in the in dealing in yuan and so on and so forth, but I hadn't quite made the connection of it being part of a swap agreement. But that is certainly interesting. Now, if you're right, and such a large proportion of China's trade is now covered by these swap agreements, then this really does have fundamental implications for the US dollar. I would have thought. I mean, quite a lot of US dollars must be redundant abroad, and it must put pressure on the on the currency. And I noticed in your article you showed a chart of the US dollar index, which looked to me like an absolutely perfect continuation head and shoulders, with some considerable downside once the neckline is broken. Is that how you see things developing for the dollar?
I'm not sure I portrayed that chart of the dollar as being loaded with a head and shoulders. As I looked at it this morning, going over my notes, I looked at my own chart for the dollar index, and I say in the article that it appears calm, and the rising euro supports the DX index, and it's very actively managed. There is a little bit of a head in November, and there are shoulders in October, and another shoulder in January, February here. That is to be sure. I didn't present that chart as a message or an indication that the dollar was about to decline badly. But it could. It could. I was trying to point out that there's some deception in the dollar index, because I think close to 50% of it, I don't know, it used to be 52, then it's 48. I don't really know, but it's always around 50%. The weighting of the dollar index for the euro, which I think is insane. It's insane. It's an artifact of, say, the 1960 decade. They just didn't ever want to change that currency because of the tight link and favoritism for Europe. But my point is that for the chart, now you can talk about the head and shoulders being indicative of a decline, but my point regarding the chart is that the seeming stability in the dollar index belies a lot of the volatility of various currencies like the British pound, like the Swiss franc, like the Japanese yen. They're all just flying all over the place. The Japanese yen is down 12% in 4 months. You just don't see that in currencies. The British pound is down 5% in, I think, a matter of a couple of months versus the dollar. You don't usually see that kind of movement. These are currencies that are going down, and it's hard to say the dollar is going to collapse if you're seeing the Swiss franc not the Swiss franc. If you see the British pound and the yen go down sharply, that supports the dollar. So there's a lot of internal tumult going on inside the currencies. Alasdair, I'd like to mention something. We're talking about London. The U.S. government has done something that I think is going to anger both England and Japan. The U.S. Department of Treasury is doing something regarding sovereign bond spreads. They're always desperate to look for more support for the Treasury bond because, let's face it, it is Greece times 100. It is the biggest bond bubble in history. It's the biggest asset bubble since the housing market. And I think it's more deadly than the housing market because it's the last bubble. The U.S. Department of Treasury is doing something. They're doing spread trades. They're shorting UK gilts, your bonds, and going long the U.S. Treasuries. They're trying to, stick their elbow in the British neck of bonds in order to support the Treasury bonds. They're doing the same thing with Japanese government bonds, the JGBs. They're shorting them and going long Treasuries. So the U.S. Finance Ministry is, I think, in the process of angering, soon alienating their allies in England and Japan. I mean, very big things are going on.
But presumably, the sellers who they must be absorbing would be people like the Chinese and the Japanese. I would have thought. It seems slightly odd that they do this, given that they're buying about 90% of everything that's being issued. I mean, what you're saying is that they're having to support the market despite the fact they're absorbing almost all the new issue.
Well, they're absorbing all the new issue with pure printing press with the Weimar nameplate, as I like to say. But there's more going on at the same time. They're using the interest rates swaps, the interest rate derivatives, to create artificial demand to support the U.S. Treasury bonds because nobody's buying them.
No, that's obvious. That's obvious. Yes,
nobody's buying them. I mean, it's a headline story. One more month. And nobody's buying Treasury bonds. Well, how are interest rates staying so low? It's the Fed buying them up, but it's also the interest rate derivatives. And in the second half, I like pointing out this. It's something one should never forget. In the second half of 2010, Morgan Stanley alone put on $9 trillion of interest rate swaps to support the Treasury bonds and force the direction down in yields so they could come out and say that there's a global flight to safety when there was no such thing.
That's interesting. That is very interesting. Well, Jim, this is fascinating. I think if I can recap the things that have come out of this, I think you've illustrated that the move away from the dollar is actually a lot more advanced than commonly believed. I think you've also identified a means in which gold will be monetarized, which is in the interest of the parties involved rather than against the interest of the issuance of their own paper currencies. And that, I think, is actually a very, very interesting point. The other thing that I find fascinating is you've pointed clearly to the use of Yuan swaps as a replacement for the US dollar. And I would guess, and just one final question really, I would guess that the Chinese strategy on this is not so much to use gold, but to back their currency as much as possible, in the sense that they own lots and lots of gold, and then use their currency in these swaps as a way of moving all their trade eventually away from dependence on the dollar. Do you think that's the sort of strategy they're looking at?
Yes, I do. And there's a missing piece in there, and that's the gold trade note that I believe is very close to being introduced. Why would China accumulate a lot of gold unless they wanted to make the yuan a gold-backed currency? Well, that's one possible explanation. Another could be that China will be the main repository for gold when different participating trade nations want to purchase a gold trade note. So they purchase a gold trade note by perhaps purchasing some of the gold that China owns. The big central bank for gold in trade settlement might reside in China. Now, you talk about gold being monetized. I think this monetization, I don't use the word monetized, but the gold is going to become the basis of trade settlement, and therefore bypass the U.S. controls with SWIFT codes and banks and with Forex transactions and all the different chicanery going on behind the Treasury bonds, which is, let's face it, Treasury bonds and bills are used as money. If a nation like Korea wants to buy crude oil from Saudi Arabia, they give them Treasury bills and Treasury bonds to make payment, usually Treasury bills, the short-term instruments. I think we're going to see more and more usage of gold in trade settlement. And the device, I call it the letter of credit, I believe is going to be the gold trade note. It's going to be a 30-day, a 90-day, a 60-day note used for that purpose. And I think China is accumulating gold. I am told by my contact, The Voice, that the Chinese official gold is between 5 and 10 times bigger than what they actually state. So it's between 5 and 10,000 tons, which is on the order of what Fort Knox used to be before it was raided and pillaged by the Clinton administration under the direction of Robert Rubin, which is a story in itself. So the monetization of gold, I think, is going to come in an indirect fashion, Alasdair. It's going to be in trade settlement. It's a non-dollar trade settlement. All right, if they're going to push Iran into attempting to survive by a non-dollar settlement, then maybe the entire East, including China, is going to do the same.
Yeah, no, I think that makes sense. I mean, I've been beating the drum for some time about the Shanghai Cooperation Organization and how eventually China will look to trade do most of her business with Asia, and she will see it as her own huge domestic and backdoor market, as it were. And for that purpose, she needs to get away from the dollar. And it's stated in the SCO's objectives that not only are they doing huge, great cross-border infrastructure projects, but they are also talking about finding a common trade settlement system. So this, what you say, I think fits in with the SCO's objectives.
Yes, it does. And you really need to take a close look at Turkey. And anyone who recently subscribed to the Hat Trick Letter, take a look at the December gold report, golden currency report, I call it, because it outlines a number of details of what Turkey is doing. And again, The Voice confirmed to me, yes, you see it correctly. Turkey is being used as a test case, as an intermediary for trade settlement in gold. A tremendous amount of flow of gold is going through Ankara, Turkey. Why? Where's it going? For what purpose? You just don't look at the data and say, well, that's interesting. No, it begs a big question. Is it being used as intermediary? I believe it is. for gold trade settlement.
This is interesting because we all know about Syria, we all know about Iran, and we all know that nobody will take their currencies, and therefore gold, is sort of quite naturally used by common traders, if you like, businessmen, merchants doing cross-border trade. So you're saying it's actually a lot more important than that rather natural function in a disturbed area.
Yeah, and notice also that Turkey is not being painted with a vile brush.
Well, she's a member of NATO, apart from anything else.
Well, that's interesting too. So it's a swing state in NATO with available Air Force bases near the old Soviet Union, but now it's a swing state in this gold settlement movement. And notice that Turkey is not being painted with that terrorist brush from the United States, which I find to be, offensive to anyone with an intelligence. Iran being painted as a terrorist nation. Why? I think they're painted as a terrorist nation because they don't like using the dollar in their energy trade. Therefore, they're a terrorist nation. No, they're a terrorist nation because they don't like the games being played by the banks, by the currency markets, by the bond markets, by the Americans, and by the British. Turkey is not being painted that way. I noticed that last autumn, there was a bank in Turkey that was involved with settlement of transactions with Iran, and they were in trouble. Well, those stories have gone away. Turkey is not under the spotlight for giving undue assistance to Iran to help them with trade and settlement and banking functions. So if we ever start to see, more attacks on Turkey, you'll know that there's some desperation in the wind. But I firmly believe Turkey is under somebody's wing. And I don't know exactly how it is all played out. But hands off Turkey and criticism as they go about their intermediary role in gold settlement. Something very big is going on. It's all about non-dollar trade settlement. It started years ago with the bilateral swap accords for Chinese yuan currency, and now it's becoming much more open if you know how to look for it. And the Western press, the British press, U.S. press, they don't cover it at all.
No, I think that's true. Well, Jim, thank you very much indeed for that. I think 3/4 of an hour has been fascinating. But before you go, our listeners can find you at goldenjackass.com.
Yes, I published the hat trick letter, and the website is www.goldenjackass.com. I'm just about done with my 9th year. It's just intriguing and interesting and fascinating, this business. It's a labor of love. I love it. There are 2 reports that come out each month. One is called the Money War Report, and that's the high-level things, currency wars, central banks policy opposing each other, like the Swiss losing a mountain of money as Japan pushes down its currency because the Swiss have been trying to diversify all the euros that they're lapping up. So big things you'll find in the monetary war report. But then I've also got a golden currency report where more nuts and bolts, like activity for gold movement in Turkey, activity with Indian banks, activity with some of the presage, pre-events for gold trade settlement. And so that's where you find the 2 reports, and it's competitively priced. And I hope people can get on. There are plenty of free articles that I write. And if you go to the Golden Jackass website, and there's one page called main5.html, and that includes the interviews like this and free public articles like what I wrote yesterday. So there's plenty of free stuff, but a lot more detail, Alasdair, and a lot more forecasts and tying things together is found in the paid reports where subscribers can access.
Well, thank you very much for that. And I can recommend to our listeners to have a look at the site and particularly read the article, which is entitled Pitched Currency War and US Dollar Rejection. Jim, thank you very much indeed.
My pleasure. Thanks for having me.
subscribe to the Gold Money newsletter at www.goldmoney.com to receive email updates on new articles, videos, and iTunes podcasts from our Gold Research section.